Okay, so you run a criminal enterprise, and you have a problem that has nothing to do with getting caught selling drugs, running a scam, or taking a bribe. Your problem is simpler and stranger than that. You have too much cash, actual physical cash, or digital cash, sitting in an account that everyone can see, arrived from nowhere legitimate. You cannot buy a house with it. You cannot deposit it without a bank asking questions. You cannot even spend it on something as basic as a car without leaving a trail that points directly back to the crime that generated it. This is the problem money laundering exists to solve, and understanding how it works is really understanding one of the strangest supply chains in the world, an entire global industry built around a single task, making dirty money look like it was never dirty at all. The United Nations Office on Drugs and Crime estimates that the amount of money laundered globally every year equals somewhere between 2% and 5% of the entire world's GDP. In today's terms, that's an estimated $800 billion to $2 trillion a year, moving through the financial system, disguised as something legitimate. To put that in perspective, that upper estimate is larger than the GDP of Canada. This isn't a fringe activity happening in back alleys. It's an industry with its own specialists, its own infrastructure, and its own economics, running quietly underneath the legitimate financial system every single day. Before we go further, it helps to understand the three stages that show up in almost every laundering operation ever studied by regulators and law enforcement, because the process follows a remarkably consistent structure no matter what the underlying crime is. The first stage is called placement. This is the moment dirty cash first enters the financial system, and it's widely considered the most dangerous stage for a criminal organization because raw cash is the hardest thing to explain. A street-level drug operation generates enormous volumes of small bills, and physically moving that cash without triggering a bank's reporting systems is a genuine logistical challenge. This is why so many laundering schemes begin with cash-intensive legitimate businesses, restaurants, car washes, vending machine routes, businesses where it's plausible, even if untrue, that a large amount of cash came through the door in a single day. The second stage is layering, and this is where the real complexity of the industry lives. Layering means moving money through multiple transactions, accounts, companies, and sometimes countries, specifically to obscure its original source. Money might pass through a shell company in one jurisdiction into an account in a second country with weak financial disclosure laws, used to purchase an asset that gets resold, with the proceeds wired to yet another account. Each individual transaction can look mundane on its own. It's only when investigators trace the entire chain that the picture becomes visible, and that tracing can take years, because the whole point of layering is to make that trail as long, as international, and as boring-looking as possible. The third stage is integration, the final step where laundered money re-enters the legitimate economy looking completely clean. This is the payoff stage. The money buys real estate, funds a legitimate-looking business, or sits in an investment portfolio, and from this point forward, it functions exactly like money that was earned honestly. The criminal can now spend it, invest it, or pass it to their children without triggering the questions that raw criminal proceeds would have triggered on day one. Real estate has become one of the most significant integration points in the entire laundering economy, and the reason is structural, not accidental. Property transactions in many countries, including luxury purchases in cities like London, New York, and Miami, have historically allowed buyers to purchase through shell companies or trusts without disclosing the ultimate human being behind the purchase. A property worth tens of millions of dollars can be bought entirely in cash, held by an anonymous corporate entity, and later sold, with the laundering essentially complete the moment the deed transfers. Transparency International has repeatedly flagged luxury real estate markets as a major weak point in global anti-money laundering enforcement, precisely because property doesn't ask where your money came from the way a bank teller does. Trade-based laundering is a less visible but equally significant method, and it works by exploiting something every country relies on constantly: cross-border trade. A company might invoice a shipment of goods at wildly inflated or deflated prices relative to their actual market value. The difference between the real value and the invoiced value becomes a mechanism for moving money across a border, disguised as ordinary commerce, hidden inside the sheer volume of legitimate global trade, where customs authorities cannot meaningfully audit every invoice for every container crossing every port. Now let's talk about scale, because the case studies here are genuinely staggering. In 2012, HSBC agreed to pay $1.9 billion in fines after a U.S. Senate investigation found the bank had failed to prevent Mexican drug cartels from laundering hundreds of millions of dollars through its accounts, in some cases funneling cash through the bank at a rate the investigation described as physically impossible to have occurred without institutional negligence. Boxes of cash, sized specifically to fit through teller windows, were reportedly deposited daily, and the bank's own systems flagged only a fraction of the transactions that should have triggered scrutiny. An even larger case case unfolded at Danske Bank's tiny Estonian branch. Between 2007 and 2015, roughly 200 billion euros in suspicious transactions flowed through that single branch, an amount that dwarfed the entire GDP of Estonia itself. Investigators found the branch had been used as a conduit for money originating largely from Russia and other former Soviet states, moved through non-resident accounts with minimal scrutiny, in what regulators later called one of the largest money laundering scandals in European history. The bank's stock lost more than half its value once the scale of the scandal became public and its CEO resigned. These cases point to the uncomfortable core truth of this industry. Money laundering rarely succeeds because criminals are brilliant. It succeeds because the legitimate financial system has genuine incentives to look the other way. Banks earn fees on every transaction, every account, every wire transfer. A compliance department that flags too aggressively slows down business and frustrates profitable clients. The economic gap between what a bank earns by processing a suspicious transaction and what it risks if that transaction is later discovered has, in case after case, tilted in favor of processing first and asking questions only when regulators eventually force the issue. Cryptocurrency has added a new and genuinely more complex layer to this landscape. Blockchain transactions are permanently recorded and publicly visible, which sounds like it should make laundering harder, and in some ways it does, because that permanent record gives investigators a trail that never disappears. But the emergence of mixing services, tools that pool and scramble cryptocurrency from many users to obscure its origin, along with the sheer speed and cross-border nature of crypto transfers, has created new placement and layering techniques that regulators are still building the legal and technical tools to fully address. Chainalysis, a blockchain analytics firm that works closely with law enforcement, has estimated that billions of dollars in cryptocurrency get laundered through such services annually, a number that has grown substantially as crypto adoption has widened. So why does any of this actually matter beyond the criminals directly involved? Because money laundering isn't a victimless accounting trick, it's the mechanism that makes profitable crime sustainable at scale. Human trafficking networks, drug cartels, and corrupt political regimes only remain financially viable because laundering infrastructure exists to convert their proceeds into usable, investable wealth. Break the laundering pipeline, and you don't just catch individual criminals, you damage the entire economic incentive structure underneath organized crime itself. This is precisely why regulators increasingly treat anti-money laundering enforcement as a crime prevention strategy in its own right, not merely a bookkeeping exercise that happens after the fact. There's also a broader economic cost that rarely makes headlines. The International Monetary Fund has noted that large-scale money laundering distorts real estate markets, inflates asset prices in cities where anonymous capital flows in heavily, and undermines the reliability of financial institutions that ordinary depositors rely on. When a bank like Danske or HSBC gets caught facilitating laundering at scale, the fallout isn't limited to the fine. It erodes public trust in the financial system that everyone, criminal and law-abiding citizen alike, ultimately depends on. The uncomfortable conclusion here is that money laundering isn't an underground activity happening at the margins of the economy. It runs directly through some of the largest, most respected financial institutions in the world, not always through malice, but often through a structural mismatch between what compliance costs a bank in the moment and what negligence costs a bank years later, once regulators finally catch up. Understanding that gap and closing it is one of the genuine ongoing challenges facing the global financial system, and it's a challenge that, so far, the criminals moving trillions of dollars a year have consistently found ways to stay ahead of.